Class is in session. Welcome to Finance University, the only school where the tuition is free and the degree actually pays you back. I'm your Dean of Dollars, and today we are performing a full-blown forensic audit on our latest research materials. We're going to dig deep into the psychology of your wallet to uncover a truth that could, and I mean really could, change the way you see every single dollar you earn and spend.
Okay, let's just get right into it. We are starting off by tackling the biggest, fluffiest, most persistent piece of financial dogma that's been handed down from old school economics, and that's the idea that money is fungible. It's one of those fancy words economists love to throw around, probably to justify their salaries, but the concept is simple and, as we're about to find out, fundamentally wrong.
That's right. I'm saying it loud and clear for everyone in the back. A dollar is not a dollar. I know, it sounds crazy, but stick with me. The dollar you got in your tax refund just doesn't feel the same as the dollar you earned from your paycheck, does it? That $100 you want in a bed? Totally different from the $100 you would carefully set aside for your emergency fund. And yeah, that difference might start in your head, but trust me, its impact on your financial health is incredibly real.
So if a dollar isn't just a dollar, then what in the world is going on? Well, it turns out your brain is running a secret accounting firm, completely without your permission. It's a little something called mental accounting, and it's the very reason our financial decisions can sometimes look, well, a little messy, kind of like a college dorm room after finals week.
So here's the textbook definition for you, pioneered by the brilliant Richard Thaler. Mental accounting is just our brain's tendency to create these little invisible buckets for our money. We treat cash completely differently depending on which bucket it came from or which bucket we're planning to put it into. These mental walls we build are unbelievably powerful, and they basically make a complete mockery of that old idea that all money is interchangeable.
Now, what's so interesting here is that you're probably looking at this list and nodding along, right? Because we all do this. That bonus money from work, that feels like fun money, doesn't it? It's practically begging to be spent on something frivolous. Your tax refund? Oh, that's already earmarked for the new TV. But the money in your emergency fund? Nope, that account is under lock and key, guarded by a psychological dragon. It's the exact same money, but the label we slap on it changes absolutely everything.
All right, let's put on our detective hats and investigate our first case study. We're going to treat this like a financial crime scene, because frankly, what's happening to people's bank accounts is downright criminal. Our prime suspect? You guessed it, mental accounting. And the crime? A paradox that costs millions of households a fortune every single year.
So here it is, the central mystery. Why on earth would any sane person keep thousands of dollars sitting in a savings account earning next to nothing, while at the very same time they're paying these punishingly high interest rates on credit card debt? Look, from a purely rational, a dollar is a dollar perspective, this makes zero sense. You are effectively just lighting your money on fire. But it happens all the time.
And the evidence on this, coming from the National Bureau of Economic Research, is just staggering. A whopping 57.6% of American households with a credit card are letting that balance roll over, month after month. This right here, this is where you should be seeing flashing red lights and giant downward sloping arrows on your screen. This isn't just some small quirk. It's a systemic financial problem, and it's fueled by our own psychology.
And this just illustrates the sheer absurdity of it all. Here's the side-by-side comparison. On the left, in your emergency fund mental account, your savings are basically on a tricycle, slowly, painstakingly pedaling uphill. Meanwhile, on the right, your credit card debt is in a Formula One car, and it is lapping you every single month. By keeping these accounts mentally separate, we're letting the race car just keep winning, draining our wealth.
Okay, for our second case, let's look at a really fascinating twist that's coming out of the world of digital finance. Now, common wisdom and a lot of the early research suggests that the less physical your money is, the easier it is to spend, right? Credit cards, tap to pay, they all seem to loosen the purse strings. But is that always true?
This is the key question. If credit cards make us spend more because the so-called pain of paying is lower, then surely mobile money, which is probably the most abstract form of money we have, it must be like a spending super catalyst, right? Well, a recent study from researchers at Florida International University decided to put that theory to the test, and the results, they were not what anyone expected.
Okay, get a load of this. In a study conducted in rural Bangladesh, when people were asked to simply think about paying for a basket of goods with their mobile money instead of cash, their willingness to spend actually dropped by a staggering 24%. Let me say that again. Using digital money made them want to spend less. This result just flies in the face of everything we thought we knew about payment effects. So what on earth is going on? The answer, it turns out, lies in a supercharged version of mental accounting called the earmarking effect. See, in the context of this study, many of the rural households were getting money sent from family members working in cities, and it was coming in via mobile transfers. So this money wasn't just money, it was mentally earmarked for important things like savings or their kids' education or healthcare. It arrived in a digital bucket that was labeled serious stuff, which made them way less likely to spend it on everyday groceries or a bag of potato chips. It proves it once again, a dollar is not a dollar.
All right, so we've audited the research, and the verdict is in. Mental accounting is real, it is powerful, and it's almost certainly affecting your finances right now. So, as your Dean of Dollars, I can't in good conscience let you leave without some homework. It is time to audit your own mental accounts.
So here is your 101 level takeaway. First, just become aware of it. I mean it. Grab a piece of paper or, let's be real, the Notes app on your phone and actually list out the mental buckets you use for your money. You might be surprised to find out you have more secret accounts than a spy. Second, you got to start fighting back by trying to see all your money as one big pool. The best way to do this is to focus on your net worth. That's your assets minus your liabilities. That one number forces you to see that a dollar paid toward 25% interest at is way more valuable than a dollar earning 1% in savings.
And that really brings us to the final thought I want to leave you with today. I want you to take a hard look at the mental buckets that you've created. Is your fund money account just enabling you to ignore that high-interest debt? Is your emergency fund so sacred that it's actually costing you hundreds, maybe thousands in interest payments every year? Which one of your mental accounts is costing you the most?
That's the bell for today, folks. If you want your financial degree to keep paying you back, make sure to smash that like button and subscribe to join the student body. To keep the lights on here at the university, check out our affiliate links in the description and the pinned comment. It's the best way to support the channel. Remember, we drop fresh knowledge every Wednesday and Saturday. Class dismissed.